Okay, well, let's focus now on the Fed and the fright it gave to the markets yesterday. Let's get more from Jay Bryson, chief economist at Wells Fargo. Jay, thank you very much indeed for joining us. A lot of disappointed little faces, it seemed yesterday. We might only get, you guys in the States might only get 2 rate cuts next year.
Yeah, that's what the Fed kind of telegraphed in their so-called dot plot. I mean, I think everybody was expecting the dot for 2025 to, come up by at least 25 basis points, and the Fed, did it on 50 basis points. And it was also interesting, Andy, when you look at the voting, one of the members actually, dissented. The president of the Cleveland Fed actually dissented on that rate cut yesterday, and there was other members. Given what was in the dot plot, they probably would have voted against it as well if they were voters yesterday.
Yeah, that's right. So what does that indicate when you get a wide range of views, even disagreement among Fed officials?
Well, it generally means you're kind of at an inflection point, shall we say? When things are moving in one direction, like the economy is really, really weakening or inflation's going up real fast, it's easy to get lots of agreement. When you get to a point like we are right now, with inflation kind of stalling out and the economy holding up pretty well, that's kind of where you get, the inflection point, maybe some differences in terms of opinion about what should be happening in terms of monetary policy.
I guess after decades of low inflation, central bankers are still relearning how to deal with this phenomenon.
Yeah, so if you look here in the States, and I mean, this is true just generally, not only, here in the States and Canada, in Europe, et cetera. If you look at, the last decade, at least in terms of the Fed, they consistently undershot their 2%. And there's nobody on Fed board who really had to deal with the really, really high inflation of the 1980s. And so, yeah, I guess they're learning their lesson. But I guess the good thing is when the Fed goes back and it looks at history, it recognizes that one of the biggest mistakes it did back in the 70s and 80s is it let inflation expectations become unmoored. And so the Fed is very serious, and I think you heard this with Chairman Powell yesterday, very serious about, we've got to get inflation back down to 2%, we got to get it under control. And so, they certainly know that historical lesson.
When you say unmoored, the central bank lost credibility with investors. They feared it wasn't determined enough to bring down the pace of price increases.
No, I wouldn't say that. Certainly not yet. I mean, if you look at market-based measures of inflation expectations, they all remain pretty settled at this point. The same thing when you look at surveys of consumers, the same sort of thing. If you ask consumers, what do you think inflation is going to average over the next 5 to 10 years, they're saying 3%. Now, that sounds a little bit high, but still, that has not broken out to the upside, even back during when we had the big spike in inflation back in 2022. And so this is not the 1970s, not the 1980s, when people expected double-digit rates of inflation on a year-in, year-out sort of basis.
Sorry, I misphrased that, but when you say unmoored, back in the 70s or 80s, people tended to lose faith as central bankers were resolute enough.
Oh, yeah, absolutely, for sure. Back then, is that there was 2 oil shocks, and then the big price spikes that we got after that. Not only did people expect higher inflation, but when you look at if you look at the long end of the yield curve here in the United States, I mean that was up 15-20%, building in high expectations of inflation for years and years to come. Today, the yield on the 10-year Treasury security here in the States is only 4.5%. So. No, certainly not like it was back in the 70s and the 80s.
Did you say that the 10-year yield at one point went up to about 15%?
Yeah, that's so, you talk to people my age here in the United States who were getting their first homes back then, they'll tell you, yeah, my mortgage was 20%, back in 1981, 1982. And, today, we're talking a mortgage of, for many folks today, they think it's high, but, it's 7% for the 30-year fixed rate mortgage. But it's certainly not that 15 to 20% that people, again, some of the people my age were talking about back then.
That's amazing. I mean, that's Tony Soprano style interest rates. It's incredible to believe that the economy was like that. You think there's a good chance the Fed stands pat then in January?
Yeah, knowing what I know right now today, I would really be surprised if they go by another 25 basis points in January. Of course, that's still a month out. Unexpected things could happen between now and then. But given what Powell was saying yesterday, given the messaging that came out of that meeting, I think they're very much going to be in a pause mentality, at least at next month, just to see how things are progressing in terms of the economy.
And do you pay a lot of attention to what President-elect Donald Trump says or doesn't say about Fed policy, or is that really political theater?
Well, I think that's more political theater. I mean, at the end of the day, in order for, and Mr. Trump has talked about having a voice at the Federal Reserve, for that to happen, that would require a change of the Federal Reserve Act. That would require Congress opining on that as well. And I just don't see Congress changing the Federal Reserve Act to give the president a voice on the FOMC. The Fed has been, by and large, very successful over the last 4 decades or so, and so again, there'll be talk about this and everything. I think the president-elect, when he becomes president, will continue to jawbone the Fed, but I don't see Congress changing the Federal Reserve Act to give the president or somebody in the executive branch a vote on the FOMC.
Thank you very much indeed. Really appreciate your giving us the time. Jay Bryson.
Thank you. Thanks for having me.
Chief Economist at Wells Fargo.